Good morning, learners. I welcome you all on behalf of myself and on behalf of Indira Gandhi National Open University. Today we are going to discuss a very important topic which is related to income tax, that is salaries. Before going into the depth of this topic, I would like to throw some light on income tax. What is actually income tax is? You know, individuals and organizations do some business, they used to work in the organizations, they generate some revenue. Once they generate revenue, they have to pay the income which they have generated, and in the form of income tax. So in this income tax we have got different heads known as salaries, house property, business and profession, capital gain, and income from other sources. We are here to discuss more about salaries, that is giving more emphasis to salaries, how the individuals who are salaried people draw their salaries. So this is all about. We have today with us Dr. Madhulika, who is expert in this area. She had a good experience in accountancy, cost accounting, income tax. Here she is today to discuss and talk about salaries. I request Dr. Madhulika to please carry on the session.
Thank you, Dr. Subodh. Before I start my presentation, I would mention here one thing. Those students who will appear in June 2008 and December 2008 examination, for them the assessment year is 2008-9 and the previous year is 2007-8. Our IGNOU material is fully updated for this assessment year. Now I would start my presentation. As Dr. Kesarwani mentioned that there are 5 heads of income, like income from salaries, income from house property, income from capital gain, income from business and profession, and income from other sources. All the incomes to the assessee are put in these different heads according to the nature of the income, provided that these incomes should not be exempt from tax. But the taxable income from all these heads should be calculated separately. First 4 heads are a specific head, whereas the 5th head is a general head. Any income arising or acquiring to the assessee which not fall in the first 4 head must be fall in the 5th head. Thus, the income which is not specific income will not fall in the specific head, shall be fall in the 5th head, which is a general head. For computation of total income, all the income from different heads should be calculated separately. Total of net income from all the heads are called gross total income. Salary is the first head among the 5 heads of income. Basically, salary means a payment made by employer to his employee in consideration of his services rendered in favor of employer. According to Income Tax Act, any remuneration is called salary, which is paid by employer to employees monthly or time to time in return of their services. The remuneration also includes monetary values of those perquisites along with cash receipts which are provided by the employer to the employee.
So Dr. Madhulika, I want to interrupt over here. Since you have talked two important thing, that is salary and SSE, I want to
salary and
SSE. What is actually SSE is, because there are many learners who may be new to this subject. They want to get a depth of the meaning of SSE. This is my first question, and once we will get the answer of it, we will move to the second question.
Actually, salary is a income which is generated by individual itself or himself. Like if an employer is paid to his employee in terms of salary, like wages, commission, bonus, advance, arrears, and income from other sources is a different aspect. Suppose if a person is doing a teacher is doing evaluation work or checking copies, whatever the income
had been generated
from the university or examination center will go under the head income from other sources, because there is no relationship between employer and employee.
Yes, that is very true, because so one important point which one has to be noted, that the individuals, whatever the individuals draw,
exactly,
it's called as a salary, the nomenclature given to him as a salary.
But for salary, it is very necessary that there is a relationship between employer and employee. But in case of income from other sources, there is no such type of relationship are necessary.
Okay. Another important point is about the SSC. If you can throw more light on SSC, because once we talk about the salary and other aspects, SSC is
I would come after some time, after my 2 or 3 slides. Gross salary. Gross salary is equal to cash receipts like cash, salary or wages, bonus, plus commission, allowances, etc. So these are called salaries. But gross salary includes salary plus perquisites. Perquisites like monetary value of house, servants, gas, electricity, water, education, plus profit in lien of salaries. So all these included in gross salary. Before going to detail the chapter, we should know about the computation of taxable salary. In computation of taxable salary, basic salary, bonus, commission, arrear of salaries, advance salaries, dearness allowance, city compensatory allowance, commission on sale, medical allowances, hill area allowances, house rent allowances, tribal area allowances, entertainment allowance, education allowance, taxable amount of perquisite, employer's contribution is recognized, provident fund, excess of 12% of salary, interest on recognized provident fund, excess of 9.5%, interim relief. All these should be added and it is called gross salary. After the gross salary calculated, we will deduct some deduction, that is called deduction under section 16 of Income Tax Act, which is a compulsory deduction. Under the deduction, we will deduct 2 mainly deductions. Number 1 is entertainment allowance and second is employment tax. In entertainment allowance, there are 2 types of employees, government employees and non-government employees. First, I would like to clear that the non-government employee, if non-government employee will get any entertainment allowance, the entertainment, whatever he will get entertainment allowance, the whole amount of entertainment allowance will be added here and he will not get any deduction in under section 16. But in case of government employee, if government employee will get entertainment allowance, first of all we should add the entertainment allowance in a gross salary, then government employee will get deduction at maximum ₹5,000. Its deduction is only for a government employee. Students, you should remember one thing, that non-government employees will not get deduction. The entertainment allowance will be added in gross salary for non-government employee and he will not get any deduction in under section 16. But government employee should get deduction under section 16. Second is the employment tax, and it is deducted under section 16 whether he is government employee or non-government employee. Then after the deduction, we deduct it from gross salary, we will get taxable salary or income from salaries. It is the mainly computation form how we compute our taxable salary. Now, some important points regarding salary. An employer may be individual, firm, company or any other institution. It means employer may be individual or company or firm or any other institution. No distinction between salary and wages. According to Income Tax Act, there is no difference between manager and clerk or labor to wages. Both the taxable income will be included under the head income from salaries. Next is employer and employee relationship. According to Income Tax Act, it is necessary that there must be employer and employee relationship are necessary. For example, if a teacher is doing some examination work or evaluating some examination copy, whatever the income he will get from examination center and or university, the whole amount will go under the head income from other sources, because here there are no relationship of employer and employee between giver of employee and receiver of giver of employer and receiver of employee. Next point is salary and pension received from foreign government are taxable under the head income from salary. Tax-free salaries. Tax-free salary is if an employer shall pay the income tax on his employee's salary is called tax-free salary. Loan taken from employer shall not be treated as salary. Receipts on retirement. If a employee may get retired from the services, so he may get some receipts like gratuity, encashment of earned leave or commuted pension. Whatever he get as a receipts, the sum of the amount will go under the head income from salaries. Family pension. Family pension received by the legal hire or widow of deceased employee is called a family pension, and the whole amount will go under the head income from salaries. Sorry, income from other sources. It will not go under the head income from salaries. Dearness allowance and dearness pay. Dearness allowance is if it is under terms and condition of employment, then it will be included as a salary part. And dearness pay is always received by employee, is always a part of salaries. Third stage is process of computation of taxable salary under the head salaries.
One thing I want to interrupt over here. What you're talking about this salary income from foreign government.
Yes.
So if one individual is there who is residing in India and he is drawing any salary from outside, say from America.
Right.
Now that could become under the head salary.
That could be come under the head salary, and the whole amount whatever he may receive from American government, it will be taxable under the head income from salary in India.
In India, and say the person is also doing some work which he is getting remuneration in the form of salary, so that could be also included in the head salary.
Exactly.
So in that case,
the salary will receive from foreign government or from foreign countries.
Okay, but parallel he is say he or she is drawing any salary from India and something from outside, but that could be a different case.
Yeah, it could be a different case, because in India whatever he get from India, it depends, some amount will be taxable and remaining shall be exempt, according to Income Tax Act, whatever he gets.
Okay.
But whatever he gets from the foreign country, the whole amount will be taxable under the head income from salaries.
So in that case, we have to see whether he is a resident of India. That may be
Whether he is a resident of India or he is
non-resident.
a not ordinary resident of
Okay.
India.
So
The whole amount
that flavor we
be
will get after some time once your discussion will go on.
Exactly. So the process of computation of taxable salary under the head, basically there are three types of, there are three steps of computation of taxable salary. First is computation of gross salary, then deduction out of gross salary, then computation of taxable salary. In gross salary, what we include? Salary means basic salary, wages or interim relief or advances, whatever the employee may get. Then next is allowances. Basically allowances are three types: fully exempted allowance, partly exempted allowance, fully taxable allowance. Fully exempted allowance means if employee will get fully exempted allowance, the whole amount is a tax free and it will not included in gross salary. I mean in this pro forma. It will not included in gross salary, but it is tax free. But partly exempted allowance means the allowance whatever employee is getting, partly exempted, some part of allowance is exempt and remaining part shall be taxable and it will be included in gross salary. The exempted part is totally tax free and it will not included in a gross salary. Fully taxable allowance means the whole amount whatever employee gets, the whole amount will be taxable under the head under gross salary at the time of computation of gross salary. Then next is perquisite. The question arises, what is perquisites? Basically perquisites is a monetary benefit given by employer to his employee besides salary or along with salaries. Like employer gives to his employee car with chauffeurs, rent-free accommodation, furnished flat, domestic servant, etc. or education, his children's education, etc. So we should calculate all these perquisite in monetary terms, and monetary value will be added in a taxable salary or in a gross salary at the time of computation of gross salary. So these are perquisite. Perquisite are also three types. Number one, taxable perquisite for each employee. Taxable perquisite for each employee means perquisite whatever employee are getting from their employer, whole amount will be taxable for every employee at the time of computation of gross salary. Taxable perquisite for a specific employee. So who is specific employee? The specific employee is a full-time or part-time director in employer's company, or employee has a substantial interest in employer's company, or he has 20% equity share in employer's company. And number thirdly, if employer's monetary value will salary he must exceed 50,000 after deduction under section 16. So these are called specific employees. Third is, so if these employees will get a special kind of perquisite, the taxable perquisite will go under the head salary, and it will be added at the time of computation of gross salary. And thirdly, exempted perquisite for all the employee. If employees are getting exempted perquisite or tax-free perquisite, it will not be included at the time of computation of gross salaries. So it is totally tax-free perquisites. Now, the meaning of salary. According to under section 17 subsection 1 of Income Tax Act, the term includes the following receipts. Number 1, basic salary or wages, bonus, commission fees, interim relief, overtime payment, annuity, advance salaries and arrear of salaries, annual accretion in employees recognized provident fund, contribution made by central government in previous year under notified pension scheme in employees account referred to in section 80 CCD with the effect from assessment year 2004-5. Encashment of earned leave, gratuity, compensation on retrenchment, amount received on voluntary retirement. These are salaries. Now, next point is encashment of earned leave. Encashment, it is also called leave salary. If employee takes retirement from the services or he resigns from the services, employer gives him some amount for his earned leave. It is called encashment of earned leave. Some part of encashment of earned leave will be taxable and remaining part shall be exempted from tax. There are two types of employee, government employees and non-government employee. Here we are, there are following provisions for the government and non-government employee. For government employee, the whole amount of sum received by the central government, state government and local authority will be fully exempted from tax and it will not taxable under the head income from salary. Similarly, the encashment of earned leave received by their legal hires will be fully exempted from tax and it will be not included under the head income from other sources. Now next is the non-government employee. Non-government employee basically includes employee of local authority, statutory corporation and enterprises of public sector. The following four amount will be, least of the following four amount will be exempt and remaining shall be taxable. Actual amount of encashment of earned leave received or salary of maximum 10 months calculated on the basis of average salary of 10 months preceding immediately from the retirement. Calculated amount of encashment of leave for the approved period not taken during the services, maximum period of 30 days for each completed year is provided for encashment of earned leave or declared amount by the central government is 3 lakh. In following four amount will be least following four amount will be exempted and remaining shall be taxable. Students, we should take one example, then it will be more clear what is encashment of earned leave and how we will compute the encashment of earned leave. But before calculating the question, we should know that for encashment of earned leave, there are certain meaning of encashment, salary of encashment of earned leave. For calculating encashment of earned leave, salary means basic salary plus dearness pay plus dearness allowance if it is under terms of employment plus commission at fixed rate on sale done by employees. So, taxable part of encashment of earned leave is equal to actual amount received minus least of the following, least of the amount. Now we would take one example. Shri Neeraj retired on 1st December 2007 after serving 34 years 9 months in a company. From following particulars, compute taxable amount of earned leave. His salary per month Rupees 15,000 from 1st December 2006 to 31st December 2006. Leave granted 1.5 month for each 1 year services. Leave taken during service for 30 months, rupees 1,68,000 received for encashment of earned leave on retirement. So how we compute the encashment of earned leave? Here Mr. Neeraj retired on 1st January 2007 after serving 34 years 9 months. So we should take only 34 years. We will not take in 9 months. So we will leave the 9 months. Then his salary per month is preceding the year is 15,000 per month, and leave granted 1.5 month. But according to rule, we will take leave only 1 month. 15 days leave is given in the question is immaterial, so don't get confused. Students, don't get confused. We should only take 1 month leave. In his his leave, total leave in the service period is 34 months, because he served his in the company 34 months, and every year he had 1 month leave. So he availed leave 30 months. His leave due is 34 minus 30, that is 4 months. So we will calculate the 4 months leave. Exempted amount would be least of the following. Amount of encashment received, actual amount he received 1,68,000. Now we would calculate 10 months average salary. His monthly salary is 15,000 per month. At the time of calculation of earned leave, the meaning of salary is basic salary plus dearness pay plus dearness allowance if it is terms and condition, plus commission at fixed rate. But in this question nothing is given except salary, so we would only take 15,000 as a salary. In case all these items will be given, then you should take all these things at the time of calculating salary of encashment of earned leave. So we will take only 15,000, because in this question nothing is given except salary. So 15,000 into 10 is equal to 1,50,000. Then cash equivalent 4 months average salary, because his 4 month leave is due, it will be converted in earned leave, or employer is given in a monetary terms for his leave, whatever is due. So 4 months leave is due, so 15,000 into 4 is equal to 60,000, and maximum exemption limit by the government is 3 lakh. So least of the following is exempt. So least is 60,000, and he received rupees 1,68,000 as an encashment of earned leave, actual encashment of earned leave. So taxable amount is 1,68,000 minus 60,000 is equal to 1,08,000 is a taxable amount, and it would be added in at the time of computation of gross salary. Now the third main salaries part is a gratuity. What is gratuity? Gratuity is a lump sum payment which is made by employer to his employee for his past services. If employee takes retirement, or he resigns from the services, or he passes away during the services, employer gives him some gratuity. It is also called death cum retirement gratuity. The whole amount of the gratuity will go, received by the employee, will go under the head income from salary. But if the gratuity received by the legal hire of the employee will go under the head income from salaries. Basically, gratuity has been divided into two forms. First is for non-government employee and next is for non-government employee. So firstly we would see the rules of government employee. Government employee and employees of local authority according to section 10 subsection 10 clause 1. The whole amount received by the government employee of central government, state government and local authority will be exempt from tax, and if the employee receives gratuity, whole amount will be exempted and it will not be included under the head salary, or it will be not included at the time of computation of salary. Similarly, gratuity received by the government employees legal hires will also exempt and it would not be taxable under the head income from other sources. So for government employee, total gratuity is exempt from tax. It means it is totally tax free for government employees. But for non-government employee, there are certain rules and the exemption are under a limit. Basically, for non-government employee, gratuity have been divided another into two forms. Number one, non-government employees who are paid gratuity under the Payment of Gratuity Act 1972 under section 10 subsection 10 clause 1. Any gratuity received by an employee covered by the Payment of Gratuity Act 1972 is exempt from tax to the extent as stated below. Actual amount of gratuity received, next is 15 days salary, 7 days in case of employees of seasonal concern. For each year's service for a period of more than 6 months is regarded as 1 year's salary, or rupees 3,50,000, whichever is less is exempted and remaining shall be taxable under the head salary, and it would be added at the time of computation of gross salary. For meaning of salary for gratuity, here basics, we would add basic salary plus dearness allowance or dearness pay if it is under terms of employment. Student, you must remember at the time of calculating gratuity, you should take basic salary, dearness allowance if it is under terms of employment. Otherwise, you will not take in dearness allowance at the time of calculating gratuity or dearness pay. Here 1 month will be considered as 26 days, means 4 Sunday we left it. Salary for 15 days will be computed as below. For the last month salary including dearness allowance into 50 by 26. It is the formula for calculating gratuity. Now we should take one example to understand more how we compute the gratuity. After serving for 33 years 9 months in Hindustan Chemical Limited, Mr. Thomas, who is covered by the Payment Gratuity Act, retires from the services on 30th April 2006. The company pays him a gratuity of rupees 85,000. His monthly basic salary at the time of retirement was rupees 42,000 as required to determine the amount of exempted gratuity under section 10 subsection 10 of Income Tax Act. Here Mr. Thomas was serving 33 years 9 months. Hence we would take 9 months, because in the meaning of salary for gratuity, month will be considered. So the month is 9 months is given in the question, so it would be taken as a 1 year. So his total service period will become 34 years. Now we will compute the 15 days salary. So 15 days, how we compute the 15 days salary? His last month emolument is 42,000 into 15 upon 26. Here 26 means 4 Sunday we left, so 1 month is 26 days. So this is equal to 2423. Now we would calculate the least amount of the following. So he got actual amount 85,000 lump sum. His 15 days average salary is 2423 multiplied by 34, because 34 years totally he served for his company. It will become 82,382, and the government declare amount is 3,50,000. Least of the amount is exempted. So here least is 82,382. It would be less by 85,000, because he actually got amount 85,000. So 85,000 minus 82,382, the remaining amount would be added at the time of computation of gross salary. Now the next point is employees not covered under Payment of Gratuity Act 1972 under section 10 subsection 10 clause 3 of the Income Tax Act. Number first is actual amount of gratuity received by the employer. Next is salary for the service period on the basis of half month salary for each completed year. Completed year shall not be taken, but in previous question we have taken months. Months shall not be taken, considered at all, even they are more than 6. Here we will not take in months, even it will given as a 6 month or more than 6 month. But in previous question we have taken more than 6 months. So we have taken 9 months as a 1 year.
So why you are taking 9 months like
it is a rule.
You are rounding off it.
It is a rule.
If the month is say 8 months or 6 months, then what you will do?
Suppose if for employees who are covered under Gratuity Payment Act, and he will suppose he served 22 years 4 months.
Okay.
Employee is covered under Gratuity's Payment Act. He served his services 22 years 4 months. Here 4 will not taken, because we will only taken 6 or more than 6 months.
Okay.
Under the Payment of Gratuity Act.
So if that individual person is in the bracket from 6 to 9 months, you are going to take full year.
Exactly.
You are rounding it off and making it full year.
Exactly. But if employees are not covered under Payment of Gratuity Act, we will not take in the 6 or more than 6 months at all.
Okay.
It's a IT rule.
In that case, you are going to take the actual.
Yeah. In that case, we are going to take actual.
Okay.
It is a income tax rule.
So this is a very important point where there is rather we can say it's an error area where if the students are not cautious, they can done a mistake. So
exactly.
one should be very cautious.
Should be very cautious at the time of calculation of. So here actual amount of gratuity received by the employee, salaries for service period on the basis of half month salary for each completed year. Completed year shall not be taken, completed year shall be taken, month shall not be considered at all, even they are more than 6. Now the last is rupees 3,50,000 is the maximum limit by the government declare, central government declare. So least of the following shall be exempt and remaining shall be taxable, and it will be added under the computation of gross salary.
So if we compare with the last example what you have quoted, in that 82,000 figure was the least amount.
82,000, because we have calculated 82,000.
And other was 85,000 and
Other was 5,000 which he actually got.
Okay.
And 82,000 was we have to
what we have calculated. Okay.
So the least amount would be exempt and remaining shall be taxable.
Okay.
So actual minus least amount.
Okay. So 85,000 minus whatever the actual amount is.
Whatever the amount will be occurred,
okay,
it will be taxable and added in at the time of gross salary.
Okay.
Meaning of salaries for gratuity. Salary here, salary is the basic salary plus dearness pay plus dearness allowance. If it is terms of employment plus commission at fixed rate. Student, you always. Now we come to the next main point, pension. Basically, pension is paid by employer to his employee after his retirement or death. After death, pension.
Your end, because rather we can say it's required of learning, because more practical components are there, more practices are there, and more